You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Big earnings week this week. We've got Amazon, Molly, after the close Thursday. So I think it's time to get a preview of what we might see from Amazon. And when you talk about Amazon these days, it's both a retail story, e-tail, and a tech story.
E-tail, I like
with
that.
Its with its cloud. So what do you do? How do you get an expert on both? Well, you go to Bloomberg Intelligence. Because we have Poonam Goyal. She's a Bloomberg Intelligence senior analyst for e-commerce and all that retail stuff. She joins us here, as does Anurag Rana, senior analyst on the tech side for Bloomberg Intelligence. Poonam, let's start with you here. I'm going to go back to the roots of Amazon as a retail story here. What do you expect to see and hear from Amazon this quarter about that core retail biz?
I think the retail business will be very strong for the fourth quarter. We already saw it in some of the industry numbers that were reported back in November and December, with really strong online sales, especially in November, and that momentum kind of continuing into December. So from the retail side, we expect Amazon to report a much stronger 4Q, and they'll still be driven, Paul, by the third party marketplace. So, Amazon's business is 1P and third party, where they sell stuff on their own and then they have sellers sell on the platform. We think the third party business will continue to outpace first party, but both will have strong growth rates.
Right, and that's just, that's just one piece of Amazon's business. I mean, granted, a big piece, but just one of them. So, Anurag, why don't you tell us a bit about the Amazon Web Service component and what you're expecting out of that?
Yeah, thank you. So, AWS is the biggest cloud infrastructure vendor out there. And what we have seen over the last 2 years, it has been a bit of slowdown in the growth rates of AWS. And the reason for that is it's a variable pricing model. You pay what you use. And in this economic downturn in the last, I would say, 1.5 to 2 years, companies are dialing back on their cloud usage. It's one way for them to control their cost. So that doesn't mean that they are not embracing cloud at the same pace. They're not just using as much. But we think that takes a U-turn either in this quarter or the next quarter. We are fairly optimistic based on a survey we did. We think we are coming to a point with easy comparisons. So we are fairly optimistic that over the next 12 months we'll see a rebound in growth rates for AWS and by default for Microsoft also.
So Anurag, if I'm Amazon Web Services, how do I position myself in this AI discussion here? I mean, if I'm the IR person, what am I telling my executives to say when I get on this conference call?
One of the most important things, I think the message they have been telling people is, you don't really need just OpenAI to go out and build your AI, you could say, strategy. They work with a lot of open source companies or AI vendors that have the large language models. They work with Meta, for example. They really promote a lot of Meta's large language model. So if I'm a company, you can go out and choose whichever raw material you want, whichever large language model that you want, but you can host that on AWS, and that's how they're going to make money, is by giving the building blocks of AI to companies.
So, Poonam, let's come back to the retail side of it. Obviously, the big news with Amazon today, the termination of the $1.4 billion deal with iRobot. Going to say again, pretty sure Amazon's going to be okay. But maybe you could tell us a little bit more about is this really material for them that this deal didn't go through? And of course, this we just keep hammering it time and time again. This M&A outlook, it's really tough.
Yeah, we talked about this a little earlier, and it's not material to Amazon. Just looking at the size of it, right? $1 billion, a little more than $1 billion on Amazon's scale of over $600 billion in GMV. It doesn't move the needle at all. But that said, it just reinforces our view that we've had for a long time that acquisitions for these companies will be more difficult given the scrutiny that they're under. So we do think that organic growth is what Amazon is going to have to focus on. And we think there's plenty of it on the retail side, on the advertising side, and on the cloud side.
Just a little redhead crossing the Bloomberg terminal. I'll bring to your attention Renault to cancel Ampere IPO. So not good news for the IPO market. We'll get some reporting on that coming up. And Poonam, with the e-commerce side of Amazon, what's your sense, talking to the Amazons of the world, the Walmarts of the world, how's the consumer these days and how's the spending out there?
The spending is pretty good, surprisingly. We've been talking about the consumer possibly falling off and really slowing down their spend, but we haven't seen it. The holiday numbers suggest the spending is strong. I'd still say, though, I think people are picking and choosing where they spend. They're deciding where they want to spend their dollars, and Amazon has been a place where they're more likely to spend it, given the fact that they get speed, convenience, and really everything that they want from there. But that said, I do think that on the low end, you could see some issues arise as inflation and other concerns really do hamper their spending power.
So, Anurag, Poonam was just saying how the growth story for Amazon is really going to come more from organic growth rather than acquiring it. So tell us about, on the cloud side, if you see a lot of organic growth opportunities coming from that business.
Yeah, no, we expect actually growth to pick up. We think the growth is going to be closer to 20% by the end of this year. This is a market that has a long, I would say, runway. Overall, cloud spending is still less than 20% of total tech spending, somewhere in that 20 to 25% range. I think we have a long way to go, and Amazon is right in the middle of it. They are the biggest cloud infrastructure vendor, as I said, with over 40% of the market share. So I feel fairly optimistic that this year we're going to see a rebound.
So in the cloud infrastructure side of it, who do they compete against? And is that 40% market share something that they have to defend? Is that something they can grow? How's the competitive landscape look in the infrastructure space?
Yeah, even in 5 years, if they are able to maintain it, I'll be very happy with that, because what has happened is, Microsoft has really gone out big over the last, 7, 8, 10 years, and it is now the second biggest vendor. Now, surprisingly enough, this is a space where the smaller vendors cannot really make a dent, because you need a lot of capital expenditures to come up with a cloud model, or infrastructure business. You just can't do it in your garage. You really need billions of dollars of data centers in order to really be good at this business. So right now there are two big vendors. It's AWS and it's Microsoft Azure, and then after that we have Google and the likes of Oracle and IBM after that.
So last one here for you, Poonam, just quick on the 30 seconds, looking at pharmacy and grocery for Amazon. What are the next developments there?
There's a long way to go there. We think they're still in very early innings, and it's a harder market for them to crack. With grocery, they're trying to build out their fresh business, but we really haven't seen that much progress there. And on pharmacy, they're still very, very early on. So those are businesses that we haven't even factored into our growth scenario for Amazon.
Wow, yeah, that seems like a tough nut for them to crack, and for a lot of people. All right, Poonam Goyal, Anurag Rana, two of our best analysts at Bloomberg Intelligence. Also, absolutely, some of our very first folks we brought on board at Bloomberg Intelligence many moons ago. But they give us a little preview there of Amazon because it is the giant retailer and it is a significant player in the cloud business. So you got to bring the two expert areas together, which we can do at Bloomberg Intelligence. And you can find Poonam's and Anurag's research as well as the other 400 analysts at Bloomberg Intelligence. BI-GO on the Bloomberg terminal. Best research on the street.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Big news several weeks ago in the crypto space because they finally got approval from the SEC for a spot Bitcoin ETF, and that was huge for the crypto space and big news for the ETF space as well. So let's dig in, see how things are progressing there. Austin Reed joins us. He's Global Head of Revenue and Business at FalconX. What is FalconX, you ask? The largest institutional crypto prime brokerage in the world. Austin, thanks so much for joining us here. Where are you based? Where is FalconX?
Yeah, first of all, thank you guys for having me. So excited for the conversation. I'm actually based in San Francisco, but Our team is spread globally. We have an office in Silicon Valley, New York, Chicago, Singapore, Hong Kong, and London. So a little bit of everywhere.
Who trades on your platform and what do they trade?
Yeah, so we trade with a wide variety of institutional market participants. That's everyone from today and topically ETF issuers who are active within the cryptocurrency space to hedge funds, asset managers, venture capital firms, really anyone that's looking to access liquidity on the spot markets or in the derivatives side of the cryptocurrency space. Our options business has seen substantial growth over the past couple of quarters as well. So basically, if you're looking to get access to the asset class, hedge your exposure, either in spot or derivatives markets, we work with a lot of those market participants.
Yeah, tell us, Austin, like why that recent news from the SEC regarding Bitcoin ETFs was so important, and what that's meant for your business.
Yeah, for sure. Look, I think if you look at what the ETF means in the mid to long term, really the unlock with the ETF is net new pools of capital that historically haven't had access to the cryptocurrency or digital asset market, specifically RIAs and financial advisors within the US. So $30 trillion markets, roughly 40% of US capital markets. And within that, they haven't had an instrument to access this asset class yet. And so the thought is the ETF provides a regulated instrument through which these different market participants can get access, and that will increase overall adoption over time. So in relation to our business there, where we service, we're a spot liquidity provider to a number of the ETF issuers. Within that, we've partnered to provide liquidity, and we did about 30% of the day one issuances from a trading perspective itself.
Interesting. Oh, okay. Very good. I wanted to know, like, how has that impacted your business? So you saw it day one.
We saw it day one. Look, this is something we've been preparing for years at this point, right? In terms of building out the liquidity at scale, ability to transact significant size within this market. And so we've been working with different issuers, larger asset managers, as they've been preparing their crypto strategies. And I think day one saw a significant amount of flows. And we continue to basically see consistent trading activity from those issuers.
All right. So just for our listeners and for me, you're a prime brokerage. You're not an exchange like FTX.
Correct.
Now you traded on FTX at some point, presumably.
Yeah, correct.
Right?
So we're a prime brokerage.
Right.
What that means is we aggregate liquidity from a number of different liquidity pools globally: exchanges, proprietary trading firms, market makers. And so we trade with all major venues around the world, depending on the structure where the client is in the regulatory jurisdiction. And our goal is to basically provide our clients the most seamless trading experience possible and an aggregation of that global liquidity within the market.
Yeah. And your clients, you said, are mostly institutional money?
Correct. All institutional.
Okay. So tell me then about like where the retail Bitcoin trader stands right now and like their access to ETFs.
Yeah, so it's an interesting question, right? And I think with the initial ETF rollout, the perspective would be that this would give broader access to the retail side of the market, as well as segments of the institutional side of the market. What I would say is we're still early in this ETF cycle, though, right? It was approved earlier this month. And within that, you're still seeing some platforms not actually allow their end clients to trade this asset, right? Vanguard is an example, $7 trillion of assets that are invested there. You're not seeing them basically allow access to Bitcoin ETF vehicles. You've seen some of the other brokerages still working through that cycle. And so from a retail investor perspective, it should open up access, but I think it's also a longer term cycle as to how these really open up over time.
So we had Bitcoin ETF. Do you expect other crypto spot ETFs to get approved?
Yeah, so I think the next ETF that the market is looking at right now is the Ethereum ETF. And specifically within that, there's a perspective from some market participants that you could see an ETH ETF approved later this year. What I would say is, in contrast to the Bitcoin ETF, that realistically through Q3 and Q4, the market consensus was this was likely to happen. The ETH ETF, there's not the same level of consensus right now. So I think what we'll see right now, we have some clients that anticipate this happening later this year. Others think it's a longer road ahead. I think that the market's still waiting to determine what ultimately happens here.
It looks like another catalyst potentially that the SEC is seeking comments on a proposal to allow options trading on BlackRock's ETF. So how do you see that one unfolding?
Yeah, so I think one of the interesting elements in relation to the ETF approval itself is the potential to catalyze greater options market activity domestically in the United States. We've actually seen substantial options growth in our own business. Just for context, Q3 to Q4, FalconX's options business grew 10x quarter over quarter. And so currently one of the largest options market participants on the institutional side of the market. And if I look at why that matters, right? People are looking for different ways to express their views within this market, as well as to hedge their exposure. And over time, what you see as these options markets evolve around ETFs is actually greater liquidity going into those ETF instruments itself. And in the future, potentially a lowering of volatility, right? So if you look at gold as an analogy, gold ETF options markets around those ETFs. What you saw is over time, that's a more liquid market, lower volatility within that market itself, and that actually attracts more capital over time because it's a more investable asset that is less volatile.
Largest institutional crypto prime brokerage in the world. How do you define that?
How do I define
largest? Like, is it
like by volume,
transaction volume? How's that
Yeah,
work?
so defined from a volume perspective there, right? So like I mentioned, we're active both on spot markets, derivatives markets, and partnering with clients both in the US and globally.
So what are other, like, who do you compete with for that market share?
Yeah. So look, if I look at the crypto market and where prime brokerage sits within this ecosystem, you have different players that are providing different products and services across the board, right? It's not like traditional financial services where you can go to Goldman Sachs or JP Morgan and get basically most things that you need from an institutional market participation perspective. So where we're focused is trading, spot and derivatives markets, the extension of credit and solving capital efficiency for our customers, and providing technology to facilitate risk management. As it relates to competition, what you see is we compete with different players in each of those different segments. Those could be some of the proprietary trading firms in one. It could be other trading market participants in the other. But from my perspective, look, there's a huge market opportunity here. The question is how we grow this over time. I think the ETF is a great catalyst, and we're excited to continue with partner with a wide variety of market participants to grow the pie.
So I know that you're working with institutional clients, but I got to ask on behalf of myself and maybe other, retail participants who are maybe a little bit hesitant to get into crypto. There's obviously, I think since it began, just been a lot of skepticism around the asset, and obviously with FTX imploding, like a lot of concerns about the viability of it. So what's your pitch to somebody who's not involved in crypto, why they should?
Yeah. So I don't spend much time actually convincing people to be active within the crypto space.
Probably because they already are with
well,
the people you deal with.
A lot of the people that come to me, right, they're actually active already.
Yes.
But look, within that, if I think what's the value within crypto, right? And where's the value within Bitcoin? And why are people excited about the ETF as an example here? What you're looking at is a non-sovereign store of value that's digitally scarce and solving what many refer to as a digital gold, right? Why does that matter today, right? We're looking at a macroeconomic landscape of 70 plus elections globally, not just in the US. Within that, we'd anticipate loosened monetary policy that could lead to inflation. Do you want to protect your assets against that? And then the other area that we see, our clients investing within crypto is some believe it could be a good geopolitical hedge over time. An increasingly uncertain geopolitical landscape, as you guys know. The question is a portion of your portfolio make sense to allocate to this asset class? But obviously, always recommend people look at all the risks and corresponding volatility associated.
Read the fine print, I'm sure.
Austin Reed, thanks so much for joining us. Really appreciate it. Austin Reed, Global Head of Revenues and Business at FalconX. FalconX is the largest institutional crypto prime brokerage in the world. And we're getting a lot smarter on crypto.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Adam Coons joins us from Winthrop Capital here. We talked to Adam about the markets and so forth going forward. Adam, we had that big September, really kind of November, December last year that just ripped. Equities just went through the roof. Bonds actually turned in positive performance for the year. What are you telling your clients here as we kind of start off another year? Do we just kind of start from zero and try to find some winners out there? What's the theme for you this year?
Yeah, I think this year is going to definitely be a stock picker's year. I think fixed income will continue to be a primary story for returns. And that's going to come despite what the Fed does, even if the Fed doesn't lower rates as quickly as some are saying. And we do believe that. We're thinking really fourth quarter before they make any cuts at all.
Wow,
maybe
that's
one.
A ways off.
Yeah. So we're a little bit divergent from the consensus, and that's really driven by if you look at what the Fed has done through this cycle, they obviously got it wrong with the transitory nonsense. And we think they're going to act slow to do the same thing, right? They were slow to raise rates, suddenly did it. We think they're going to be slow to decrease interest rates because they don't want to be wrong again, right? They don't want to lower rates and then see another flash of inflation. So I think that's really going to squeeze the economy. And so that's going to be good for long-term bonds. I think it's going to be somewhat of a difficult year for stocks, and that's driven by two things. One is what I just highlighted, is you're going to start to see economic weakness. But secondly, I mean, coming into this year, you nailed it, is we had that rally coming into the end of the year that really drove valuations to some somewhat unsustainable levels for specific companies. And I'm highlighting your Teslas, your NVIDIAs, and obviously you're seeing the result of that with Tesla missing and dropping quite a bit.
So you're saying it's going to be a good year for long-term bonds. I'm looking at the 30-year right now. Yield peaked a little bit above 5% in October. That's when the pivot story started to become a bit more clear. And now we're at 435. Think that's still attractive to get in? I do.
I mean, look, it's really asymmetric right now in bonds, which is the attractive part of it. The worst case scenario is you get a fairly high yield to carry until we start to see that, the secular trend in rates is not changed. Rates are going to go back down. Demographics and all those things are pushing that. So worst case scenario is I get to hold bonds at a pretty high yield. Corporate bonds, I'm getting 5%. So I get to hold that and wait until I'm right. And so ultimately, I think that's the easiest, like I said, from a risk standpoint, asymmetric trade.
I was surprised, looking at the performance in fixed income last year in 2023, that the best performing sector was high yield. Yeah. And that's in a world where everybody kept talking about a recession. I would have thought going into the year that maybe high yield would not be the place to be, but it really outperformed.
It did. I mean, and I think that goes hand in hand with what the equity markets did, right? They tend to correlate in certain pockets of the market. And so I think when we saw that rally, that helped tighten credit spreads. I mean, we really aren't seeing big increases in delinquencies. Yes, they're going up a little bit, but recovery rates are stable. So it's just, it was a place to be because credit markets still look pretty solid.
So in a year when rates are broadly going to be coming down, you think that's pretty accommodative for everybody? Is there really a place that you would say you would not benefit from that and to avoid?
Well, I think it really comes down to commodities. I'd stay probably away from that in the short term, especially kind of the oil commodities. But if you're looking at stocks, I think, once again, I think you want to stay away from the narrative-based companies, like I said, in NVIDIA, or where the AI narrative has really gotten out of hand.
We're over it?
Yeah, I've been over it for a while.
I feel like it's just starting.
I think there's going to be a pause, right? And then, because everyone's going to figure out, well, there's no monetization of this story of AI right now. So I think there'll be a little bit of a pause with that. You'll still see the companies like Microsoft and Alphabet that have an AI component, but have a real business model. Those will still do well. But the companies that really just kind of got over their skis last year, that's where I would stay away from right now.
So big earnings week this week from a lot of the high-profile names, including Meta and Alphabet, as I call them, Facebook and Google. Why change a good thing? I don't know. Right. But in any case, I know they're names that you guys have an interest in. How do you think about Facebook, Google, that whole, I guess, digital advertising space?
Well, I think it comes down to, once again, these are business models that have been able to adapt. Meta's gone through a little bit of an identity crisis, but I think they're back on the right track where they're able to adapt to what the consumer behavior and those shifts are. We still think the consumer can kind of push this cycle out, and that's what's going to drive stocks like that, where advertising is really, at the end of the day, the revenue driver. So that's why we think those companies can outperform relative to some of the hardware type companies.
All right, so those ones are the communication/tech sector. How about healthcare? It looks like that's one that you've got your eyes on too.
It is. I mean, if you look at valuations, and I keep saying that word, it's obviously something that matters to this year. A company like Merck, where it is trading very attractively relative to other companies in healthcare and then also just in the S&P 500. But it ran up significantly through COVID, obviously with their vaccine, and then basically has given away all those gains. So what we see here is a company that has a nice amount of cash flow. Yes, the pipeline in the short term is a little bit questionable, but we think that they can pull off an M&A strategy that will kind of help prop up their pipeline in the future.
I don't know. I mean, we just had our antitrust expert in here. I wouldn't be trying to get into M&A right now.
That's fair. That is fair. It's hard right now.
It still seems like you can get healthcare deals done, because usually what it is like a big pharma company buying a little guy who's got some cool new thing coming. So that
maybe just not in healthcare as far as insurance. Obviously the Humana Cigna, that didn't go so well.
I mean, Does Merck have, it seems like if I'm going to have exposure to healthcare, it's got to have a GLP-1 angle, an obesity drug, a
I was
going to
say they need an Ozempic.
Does Merck have that?
They don't. And I think that Lilly would be my pick behind that. The valuation is really what's giving me pause there, but I would still own Lilly. I probably wouldn't add to it, or
particularly in Indianapolis, dude. You have to own it.
Yeah, I get it. Yeah,
Eli Lilly,
gotta love Lilly.
In Indianapolis, because I know that because a lot of my friends from business school went to Indianapolis begrudgingly, but they went there because it's Eli Lilly.
Yep.
That's the place. Yeah.
Exactly. So, but still, your highest conviction trade is that high grade, long duration bond.
Boring.
So
boring.
I know. So what's what's a piece of paper that you guys hold that you feel really comfortable with?
I really do like tech, TMT. When you're looking at corporate bonds, you can go out there and.
Are you buying you own the Comcast and
yes,
that kind
absolutely.
of stuff?
Comcast,
Charter.
I like Cox
friends.
Communication.
Yeah, I like Cox Communications.
Yes,
I've banked them for like 30 years.
Look at some
Great
Dell.
company.
Yeah, I mean Oracle. Oracle is honestly one of the cheapest. It's triple B, but you're getting a lot of spread. Like so, you're getting well north of 5% for a well cash flowed company. It's a no brainer for me.
Nice. Cox Communications. Man, I made a lot of fees off of those. Good people, smart people. They made you work for it, but they paid and they paid on time. Adam Coons, thanks so much for joining us.
Thank you.
Adam Coons is Chief Portfolio Manager for Winthrop Capital Management, located in Indianapolis.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
You kind of think about 2023 and the rip we had there at the end of the year. It's like almost I come into 2024. Now what do I do? It seems like I might have gotten all my performance at the end of 23. But let's check in with Katerina Simonetti. She probably has some good views here. She's a senior vice president at Morgan Stanley Private Wealth Management. So Katerina, what's kind of the message you started off, 2024 with your clients here after a pretty good 2023?
Paul and Molly, thank you for having me on the show. Yes, surprisingly good end of 2023, where investors seem to be so excited about the potential for the rate cuts. We saw this, pretty remarkable year end, and also, somewhat unusual was the fact that the 7 large stocks essentially carried the market. So if you look at the performance that investors experienced in some of the broad indexes like S&P 500, for example, there were 2 stories of the index. There was a story of these magnificent 7 stocks and then the rest of the market. So when we look at 24, it definitely continues being the story of the Fed. And it is really the timeline of the rate cuts that we're looking at, first. And then, of course, the earnings, because to some degree, it is a little bit confusing for investors to figure out what they're hoping for. Are they hoping that rates are going to start coming down soon? And we have significant doubts that the Fed is going to start cutting in March. Or are they hoping for good earnings that for the stocks that they have in their portfolio? We think it's a little bit of both.
Well, let's delve into that timeline for the Fed rate cuts, because I feel like, you can ask 5 people and get 10 different answers on this of when the Fed cuts are going to start. We hear March the earliest. Our previous guest said, fourth quarter the earliest. So where do you stand in all that, Katerina? What do you think?
Well, we think that March is a bit aggressive. And in our view, we expect that the rates cuts are going to start in June. And of course, economic data will be something that will have to support it. So we're going to have to see some weakness, because after all, we can't forget that the rate cuts, it's economic stimulus. This is what we do to stimulate the economy. But the question, of course, also is, would Fed be willing to do something preemptively? If this week is a huge week, we have earnings, we have job data, we have the Fed meeting that is coming up, and perhaps they give us some guidance as far as what they think on the timeline, because if economy remains strong, is it something that they're going to be willing to do? But in our view, we expect less rate cuts that market is pricing in.
All right, Katerina, what are you telling your clients here in 2024 in terms of maybe stocks versus bonds? Is it client specific, or do you have a kind of a balanced approach you like to take? What's your message?
Well, our biggest message to clients right now is get out of cash. we tend to have
okay.
a little bit of, yes, get out of cash, because we tend to have a little bit of a short-term memory. And, when we think about it, it seems like we've been earning 5% on cash forever, but reality is that it hasn't even been a year. And our biggest conversations right now is extending the duration of fixed income portfolios, getting out of cash, positioning both in high quality equity, not necessarily the stocks that have done so well in the previous year, but maybe taking some profits there, but making sure that we have a nice, high quality, well-balanced portfolios on the equity side. We like healthcare, we like industrials, we see opportunities in financials, but on the fixed income side, even more importantly, we're looking at extending the duration and the quality, because this is this remarkable opportunity of picking up some of these high quality bonds and enjoying that 5% yield for longer.
Is there a lot of that out there? I mean, especially looking at corporate issuance, like you seeing much in that longer duration tenor?
Well, Molly, there is longer duration, but there's also intermediate. And when we're looking really about, that message of getting out of cash, even getting a CD that is few years out, looking at some corporate bonds, investment grade corporate bonds, just kind of trying to get as much of that yield as possible. We might not be able to get that yield going out 15, 20 years, but when we look 5 years out, 7 years out, this is really something that is still out there. Absolutely.
So on the equity side of the equation here, are there some sectors that you and your team like right here that you're trying to convey to your clients?
Well, Paul, the first message is, of course, trying to, again, getting away from the tech names that did so well, right? And it's the hardest thing to do, to know when to take a profit and to reallocate, to the areas that maybe have not done well, but are positioned, in our opinion, better. And when we look historically, usually, after the rate cuts, large cap is this sector, that usually just performs better immediately, but small and mid cap stocks, are not that far after. And in our view, with the potential for rate cuts, but also with some of the geopolitical concerns that we are dealing with, especially, some of the news that came out over the weekend as example, we really, our return expectations for this year, the risk reward, are kind of low. We are setting expectations to the clients that this is going to be the year where we position, where we get those quality positions, where we make sure that our portfolios are well diversified. We do like healthcare, we like industrials, we like financials, we like just generally dividend paying stocks as this core building block of the portfolios, but we're also setting timeline expectations that this is the positioning that is going to be more for 25 and even 26, after the rate cuts, after that stimulus hits the market, when there is another wave of growth that clients will be able to enjoy.
So Paul is a huge fan of the Russell 2000, and I know it is a burning question for him. Is there a magnificent seven of the Russell 2000?
That's, how many sevens would it take to really make an impact, in the index that has 2,000 stocks? That's the question. So I think that the answer there is just broad index versus stock picking. And in our view, this is very much the year for the stock picking, where valuations and earnings and competitive positioning of these individual names, of the individual stocks, will make all the difference in the world for the investment portfolios, for that alpha, that excess return above the market. And we actually would encourage investors to, some would take profits and decrease their positions in the broad indexes that benefited from some of the stocks that performed well last year.
Katerina, one last question, about 30 seconds. What do you do with alternative investments? How do you kind of position them for your clients?
We think alternative investments, as far as diversifier or even return amplifier, play an essential role in the portfolio where appropriate. It just really takes time to get educated in that space. But we think that at least 10-15% of the portfolio, could really benefit from some alternative exposure.
Katerina, thanks so much for joining us. As always, Katerina Simonetti. She is a Senior Vice President of Morgan Stanley Private Wealth Management, joining us to give us her thoughts on these markets.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.